Today, we're going to create a near-perfect portfolio that brings together growth, dividend income, and long-term stability. Our goal is going to be to have a portfolio that is well-planned and remains stable in good and in bad times. And why is that? Because people, we don't know when to sell and when to buy. We need to accept that. We can't time the market because it usually never works. So we need something that works well for the long term. Now, don't get me wrong, after the tech crash of 2022, the market has done extremely well in the last 2.5 years. We've seen a brief hiccup in 2025 because of Trump shooting tariffs out of his shotgun. But due to the AI revolution, gains kept flowing. The net result is that the market is not cheap anymore. Almost everything seems to be overvalued. So what do? Do we stop investing, waiting for a crash? Do we invest more? And when is a good time to invest? The answer is really simple. Every time is a good time to invest, as long as we do it with a solid and clever plan. My name is Rick, your favorite Italian investor and twin of Manu Ginobili. If you haven't subscribed to the channel, well, just like for investing, the best time to do it is now. So subscribe, ring the bell, and now let's start with the video. So guys, nothing is perfect in life, right? But we can make it near perfect. You see, if we can achieve 90% of our goals with investing, we'd probably be happy with the results. This is what we do even when we buy a house, right? We might not find the perfect one, but when we buy, we're not looking to sell it the next year. We want to make sure that the house has a solid foundation, we want it to be in a good neighborhood, with good schools, and it must not be overpriced. Once we have purchased the house though, we're not going crazy checking the market value every single day. I hope, even though we want it to appreciate in the long term. And if the housing market crashes, we're not looking to bail out of the house. In the same way, a good investment portfolio is one that is likely to meet most of our goals and that we're happy with 90% of the time. Once invested, you enjoy the income it provides, but you are not looking to sell it if it grows a lot or if there is a market crash. So, with this mindset, let's create the portfolio. First, let's define our goals for the near-perfect strategy portfolio. The portfolio should provide dividend income that is consistent and reliable both in good years and bad. It should at least match or preferably exceed the growth of the S&P 500. This translates to at least a 10% annualized rate in terms of total return. It should cover the international market to provide low geographic volatility, and it should leverage the vanguard of our generation, which is the technology market. And who is this portfolio for? Anyone who aspires to achieve financial freedom early in life. So our portfolio is going to have 4 buckets. A foundational bucket based on the US, which is going to reduce the overall volatility. A growth bucket that will push our growth in times of bull market, because we don't want to miss the tech wave, right? Then a dividend income bucket to let the cash flow even in bad times. And an international bucket to cover all the bases for the future, because let's admit it, the US is definitely losing its dominance and we see more and more countries plotting against the US, just like in the end of Game of Thrones when everybody was plotting against Cersei. Damn, I just noticed that the US debt is out of control, and so was Cersei's. Alright, let's start with the foundational part of the portfolio, which is going to take 30% of the portfolio cake. I'm gonna be quick here, I don't want to bore anyone. For the foundation, you want something that's basically unshakable. So what goes here, you heard it a million times, the S&P 500 with VOO, or if you're feeling a little extra, the total stock market with VTI. Yes, I know this is not a groundbreaking revelation. Every YouTuber, your uncle, probably even your dog has told you about these, but they are popular for a reason. And I could tell you, you don't need them, but I'd be lying. I'm not gonna bore you with the usual historical returns chart because you've seen it 1,000 times, but I'll remind you that both VTI and VOO have returned around 10% per year in the long term and have shown an extremely low volatility, which is what you want for the foundational part of the portfolio. Next up is the growth engine, the part that you're going to need if you want your ETFs to be tilted toward a sector that, if you ask me, will always be the best performing sector in the future, the technology sector. This part of the portfolio will take a 30% slice of the cake, but just like for the others, you're free to change the percentages based on what you personally want to achieve. Yes, because all of you have different goals and also different situations. Some of you are younger, some older, some have high income, some don't, some have kids and responsibilities, and some don't. So feel free to choose how much each part of the portfolio will weigh in your singular case. Now, for the growth part, I'm going to mention 5 good alternatives, and I'm going to give you advantages and disadvantages of each one. The first one is my favorite tech ETF, VGT, the Vanguard Information Technology ETF. VGT is one of the most diversified market cap weighted tech ETFs. With 317 holdings, it gives you a great coverage of the whole tech industry, tracking an index made up of stocks of large, mid-size and small US companies, with 76% on large cap stocks. Now, the earnings growth rate has been over 30% in the past 12 months, and the return on equity is also a whopping 40%. But the PE ratio is still quite high compared to the long-term average, with 40x. An alternative to VGT is XLK, the Technology Select Sector SPDR Fund, or SPDR Fund, which is simply the large cap part of VGT. So here you have the choice. Do you want to focus on the large cap growth market, which by the way has been dominating in the past 10 years, or do you also want to give trust to small caps? The truth is that since the ETFs are market cap weighted, it's not going to give you much of a difference because the large cap market is, by definition, the largest. In fact, look at this. In the past year, 25 and 27%, pretty similar. In the past 5 years, again, a quite similar result with 130% against 129%. And in the past 10 years, again. So in the end, as you see, you can freely choose and it's not going to make much of a difference, just like we always say for VO and VTI. But that's not all. There are other ETFs that you can choose for your growth part of the portfolio. One is SPMO, the Invesco S&P 500 Momentum ETF. This ETF has been delivering an incredible 18% per year in the past 10 years, making it one of the most successful broad-based growth ETFs out there. There is really a lot to say about this ETF, and if you don't know it, you absolutely need to know more about it. But don't worry, because recently I made a whole video about this ETF, which by the way, for some reasons I can't explain, has been the most successful video on my channel. So if you want to watch it later, you can simply find it on my channel or in the link that I will write in the description below. Alright, there is another growth ETF that I absolutely want you to know, and it's an ETF created by Invesco exactly 1 year ago. It's quite exciting and I might do a video about it in the future because just like QQQ, this ETF tracks the Nasdaq 100 index, so it's made for growth, but it's also designed to provide consistent monthly income, all with less volatility and low risk. I'm talking about QQA, the Invesco QQQ Income Advantage ETF. And of course, there is also QQQM, the little brother of QQQ, which is one of my favorite growth ETFs and also one of the most bought growth ETFs. If you're interested in knowing more about QQQM or QQQ, you're going to find tons of material in my channel, so just take a look at it after this video. Alright, now let's add the third layer to our near perfect strategy portfolio, the dividend income part. This is a section that pays you good dividends while you sleep, and it's gonna take 30% of the portfolio cake, just like the previous ETFs. Now imagine you are an employer who wants to hire the best dividend employee. The first day for the interview, there will be 5 applicants lined up in front of your office. Number 1, SHD, the Schwab US Dividend Equity ETF. This is the crowd's favorite, even though we must admit that it's been lagging in the past 12 months, delivering zero growth. But hey, if you think in terms of quality and not in terms of past performance, actually seeing that it didn't grow just means that you're going to be able to buy cheap. So don't always be discouraged when you see that a good ETF is underperforming. SHD is focused on quality companies with a consistent history of paying dividends. Low fees, great track record, and honestly, the dividend pay is about 3.5% and has been delivered like clockwork so far. Now, option number 2, the evergreen VYM, the Vanguard High Dividend Yield ETF. The name says it all. High dividend. And in fact, the ETF tracks the FTSE High Dividend Yield Index that has the only focus of finding companies characterized by high dividend yields. Still, the average dividend yield is around 2.5%, so a little bit lower than SHD. The advantage though is that VYM is stronger in unstable markets. In fact, you can see that the total return has been not only great, but also quite stable in the past 10 years, with a value that both short-term and long-term was always between 11 and 14%. Next one in line, VIG, the Vanguard Dividend Appreciation ETF. Now, this one's about dividend growth. VIG only holds companies that have increased their dividends for at least 10 years in a row. The upside is that you get dividends that actually grow over time, which fights inflation and is going to be a great protection in times of bear markets. The downside is that yields are a bit lower compared to SHD or VYM. As for performance, VIG fell short of VYM in the past year with 10.5% compared to 13%, but in the long term actually delivered better performance than all other dividend ETFs out there, with a total of 245%. There are two other dividend ETFs that I want to mention today, and they are both actively managed ETFs from JP Morgan that generate high monthly income using covered call strategies. The ETFs are JP, the JP Morgan Equity Premium Income ETF, and JPQ, the JP Morgan Nasdaq Equity Premium Income ETF. And there are two ETFs that all dividend investors should know because even though they don't have a great capital growth, they offer a huge dividend yield that in the past oscillated between 8 and 11% per year. Imagine you have $100,000 in these ETFs and every year they give you around $10,000 in dividends that you can reinvest. Not bad, huh? But you need to know the difference because JP and JPQ target different markets and have distinct risk profiles. JP is designed for stability by focusing on the S&P 500 and low volatility stocks, while JPQ offers higher potential income by concentrating on the more volatile Nasdaq 100. So I give you quite a few different dividend ETFs, but now, how do you pick one? This is how I would do it. If you want steady growth with dividends, go VIG. If you want higher, stable, immediate yield, VYM. If you want a proven champion that underperformed in the past 12 months and still gives a generous 3.5-3.7% dividend yield, SHD. If you want to get income every month and don't mind capping your upside, JPQ or JP. Mix them wisely and this part of your portfolio becomes the greatest income generating gift that your portfolio can have. Alright, so far we've covered the foundation, growth, and dividend income slices, each with 30% weight. Now it's time to add 10% of international exposure, the part of your portfolio that says, hey, did you see maybe where the US debt is going? Do you trust the US for your retirement in 4 years? Because yes, the US is great, but it's not the only show in town. You've probably heard of BRICS, the group made of Brazil, Russia, India, China, and South Africa. That is challenging the US. And you know that the last trade tariffs from Trump didn't really make a lot of friends worldwide. Oh, and you've probably seen how the US dollar is actually losing value now compared to most other currencies lately. Maybe the US is going to rise like a phoenix. Who knows? Who cares? We want to be sure not to lose all our money in 30 years only because the US decided to become the kid in the block that everybody avoids. And look, I'm almost totally invested in the US, so believe me, if there is someone in the world that hopes that the US will keep overperforming, that's me. Nevertheless, there are continuous discussions of if a person really needs international stocks or not. And I think that putting a part of your portfolio into this market and seeing how it develops over the years is not necessarily a bad move. So, here are the ETFs that I like for the international slice, which is going to take 10% of the portfolio cake. Number 1, VXUS, the Vanguard Total International Stock ETF. This ETF returned 22% in 2025 against 10.5% of the S&P 500. Yes, you heard that right, over double as much return than the US stock market in just 9 months. Now, I don't want to come across as cocky, but everybody enjoys saying, I told you so. And here I have to say it, I told you so. Last year, right before the end of the year, I made a couple of videos saying that the international markets would have overperformed in 2025. And that's exactly what happened. Now, back to VXUS. VXUS covers almost everything outside the US, developed and emerging markets. The pros are that it's a super broad, low cost and gives you instant global diversification. An alternative, which is very similar to VXUS but excludes small cap, is VEU, the Vanguard FTSE All World ex-US ETF. A really similar composition to VXUS, with 27% on emerging markets and the rest split between Europe and Pacific. Then we have two ETFs that you can use if you want to give different weight to developed or emerging markets. One is VEA, the Vanguard FTSE Developed Markets ETF, and one is VWO, the Vanguard FTSE Emerging Markets ETF. With the first, you get coverage on developed markets, and because of this, it has lower volatility than emerging markets. With the second, you get markets like India and China, which have a great potential for the future. So you want broad exposure, VXUS covers it all. Do you want a VXUS without small cap? Then choose VEU. Do you want stability with less volatility? Lean more towards VA. Do you want high risk, high reward flavor? at VWO for emerging markets. Now, before putting together your $10,000 portfolio, take a look at this video where I talk about SPMO, the Invesco S&P 500 Momentum ETF. Or if you're interested in a different kind of videos, try this one. Thank you so much for watching, everyone. Drop a comment and tell me what you think. And come on, if you can, be nice and help my channel dropping a like to this video, subscribing, and well, apart from this, I wish you a great day, and as always, I'll see you in the next video. Ciao!